climate change, net zero targets, gender parity, diversity, responsible business practices. These terms have taken over the economic landscape, and the most exposed organizations are now being held accountable. Sustainability reporting refers to a recent form of disclosure by organizations to their stakeholders concerning the environmental and social issues related to their activities. This results in the production of sustainability reports intended for third parties, based on the preparation of internal data useful for management. For about 2 decades, many entities, first and foremost publicly listed companies, have been producing sustainability reports with non-standardized titles: Societal or Sustainable Development Communication, Corporate Social Responsibility Reporting, or even ESG reporting for environmental, social and governance matters. This reporting generally covers 5 areas: resources and the natural environment, human resources, responsible business practices, the responsible nature of products, and finally, impact on the community. This CSR information would serve as a complement to traditional financial reporting, which by its nature is focused solely on the economic dimension. Initially voluntary, it has been the subject of numerous studies in the field of environmental and social accounting. These studies have revealed disclosure strategies aimed at compensating for poor environmental performance, otherwise known as greenwashing. For example, it has been documented that following an environmental disaster, the sector concerned significantly increases the volume of publications devoted to environmental efforts. These strategies have been described as legitimization strategies. Furthermore, the numerous studies that have explored the links between societal performance and financial performance show mixed results. And it is difficult to identify stable financial benefits, often due to a lack of data comparability across companies and countries. Today, there are high expectations to improve the quality of this reporting, which is driving the standardization of CSR data. France was a pioneer in terms of regulation, but Europe has launched several initiatives, such as the Directive on Non-Financial Information, and then the one on Corporate Social Responsibility, making this reporting and its associated verification now mandatory for companies exceeding certain thresholds. For now, Europe, the IASB as an international standard setter, and the United States have each separately begun creating sustainability reporting standards. Even though they address the same topics, these bodies do not fully align on the content and scope of the information to be disclosed. Europe promotes a principle of double materiality, which aims to examine the impact of CSR issues on the entity's activities, but also, in return, the impact of the entity on its environment. In contrast, the IASB and the United States recommend limiting disclosures to the consequences identified for the entity itself. One of the key questions is the connection between financial reporting and societal reporting, and more broadly, the role that accounting can play in the ecological transition. Many debates will arise in this area, which is still a secondary aspect of accounting, but sustainability reporting will undoubtedly become one of the top priorities for finance departments and accounting professionals in the years to come.